Right, hi guys. Welcome to my stream. My name is Zahir Anwari, co-founder of Sublime Trading, where we help CEOs and high salary earners get consistent returns in the stock market using a proven strategy and in only 30 to 60 minutes a week. And here in the UK, we show people how to do that tax-free as well. So today we're going to focus on the dollar index, have a look at what's happening and how that could potentially impact the forex markets, and we will also just have a quick look at what's happening on the indices as well. So the S&P, the Nasdaq, the Dow, the FTSE, and we'll end with any questions that you may have. So if you do have any questions, guys, I do have the chat box open. Do put them in the chat box and I will get back to you. For you guys who are watching this on YouTube, unfortunately, I pick up the comments after the channel or the stream rather has come to an end. So I will pick them up, and if you leave any questions, I will get back to you. Okay, so let's dive straight into the stream. So regular visitors to my stream, if you're watching this on recording as well, welcome. You should be familiar with the setup that I use. This is a typical three-screen setup that I have. I have the monthly time frame in the top left, the weekly time frame in the top right, and the daily time frame across the bottom. I use the higher time frames because I'm a trend follower. I'm looking for the big moves in the market. So for me to catch the big moves, I've got to have the right time frames to allow me to do that. Now, what this means is ultimately there is an element of patience involved to allow for the right setups. And when the right setups appear, it's quite straightforward because the markets then do start to move quite quickly. And that's when we can hold our positions and we can compound. If you're day trading, it tends to be a lot more work, but the profit tends to be a lot more inconsistent. Day trading is a proven wealth extraction mechanism. We've got to be really clear about this. If you're day trading and you're finding it inconsistent, it's because it is an inconsistent approach. With trend following, there's a patience involved. You do less, but over the long run, 5, 10, 15, 20 years, you make far more profit. It's more of an investment style that allows you to compound. So that's the typical setup that I have, this three screen setup. And I use this for all assets that I look at. So forex, UK stocks, US stocks, commodities. We also have people in our community from other parts of the world, India, South Africa, Canada, and they use this same setup as well to identify whichever stocks they want to invest in. Okay, so what I like to do is I like to start on a monthly, move across to a weekly, and then come down to the daily time frame. And what I'm looking for is all three time frames to be moving in the same direction, either bullish or bearish. If they're moving in the same direction, I take a position. If there's a mixture of bullish and bearish factors, I tend to stand aside. Now it's clear. I just want to be clear here as well, guys. I don't trade the dollar index. I use the dollar index in the same way that I use the indices, and that is I use it as an indicator of what the market is doing. And once the market has set up, I then take a position on the best performing currencies in that market. So let's start with the dollar index. Now, what's important here is this. If we just go back to 2014, 2015, this was when we had the last real trend on the dollar index. We can see that from this low point here, from May 2014 to this high point, which is March 2015. That was the last real trend in the market. Since then, the market has been stuck in this long-term consolidation from March 2015, that high, all the way through to June of this year. Long-term area of consolidation. You're looking at around 7, 8 years of consolidation. The market then broke out and moved higher to this high point of September 2022. Price found an area of resistance, and since the high of September, the market has been in this decline. Now, where has the market come down to? This is really what we want to understand. We can see the market has come down to this support level. It's made up of this high from January 2017 and this high from March 2020. Now, these black lines that are highlighting all these key areas of support and resistance, these are tools that we have developed. It's a script within TradingView. And what's great about this tool is that it's based on an algorithm, and when the tool detects the next level of support and resistance, it automatically starts plotting these levels for us. So I don't have to spend hours of my day identifying and drawing support and resistance levels. It's just unnecessary. If I have a tool that does that for me, great. All that means now is I can focus on doing my analysis, and then when the right setups appear, I can take a position. So what's happening is the market has come down to this support level. Now, generally what tends to happen is that when a market shoots through a level, it likes to come back to retest it. Ideally, we want to see this sort of retest quite early on in the trend. So we want to see a move, pullback, and then a continuation to the upside. With the dollar index, what we saw is price just shoot ahead, and unfortunately, price found resistance, and the pullback has been equally aggressive. Ideally, what we would have wanted, if I just compress the chart, is for that pullback, retest, and then breakout, pullback, and then breakout to happen quite early on once price had broken out of consolidation. And then we would have liked to see a nice move to the upside towards this area of resistance, ideally break through it, and then continue. That's what we would have liked to have seen. But given the way the forex market has been since 2015, this sort of whipsaw nature where it sort of remains in consolidation, then breakout, it's whipsawed again. It's not really of any surprise that we have seen this sort of move, pullback, and then next a breakout. Just give me a second, guys. Okay, yeah, all good. Streaming is good. Just getting a couple of messages. Yeah, okay, all good. So pricing now at this support level. The question is, what is likely to happen next? Well, as the trend is bullish, what we could see is potential support and a bounce back to the upside. The other outcome is that the market continues to decline back inside consolidation. And the final outcome is simply that the price finds an area of resistance, which is the high of September, and then we're at this support level, and the market just remains within this area of consolidation. As we have seen consolidation here, it's very likely that the market could consolidate here. At this point, we have no idea what the market is going to do. This is really where patience comes in. We let the market dictate, and then we react accordingly. Okay, so we are seeing some kind of bounce at the moment. You can see based on this month's candle, there is some kind of bounce and there is a wick. So we are seeing a move to the upside. Whether that's short term before a move back to the downside remains to be seen. So let's move across to the weekly time frame. Let's have a look at what's happening there. Now, what we have is the 200 simple moving average, which is the black line, and the 50 simple moving average, which is the orange line. We had this move to the upside. Price found this high in September, and since then it's been in decline. If we look at where it is now, it's back at the 50 simple moving average. If I just get my horizontal ray, if I just plot that line, what we can see is that, oh, very well drawn, there you go. What we can see is that price is now at a support zone, which is made up of this high point from March of 2020 and the 50 simple moving average. So this here is a level where price could potentially bounce and move back to the upside. If it's broken, then we could see price come back to the 100 round number and even the 200 simple moving average on the weekly time frame. Now, if we come down to the daily time frame, the daily time frame paints a slightly different picture. And what I mean by that is this move to the downside has taken price below the 200 simple moving average, which is the black line. It's below the 20 simple moving average, which is the blue line. That's acting as resistance as well. We can see that it's being forced down. The 50 simple moving average is also starting to curve down as well. So we are seeing bearishness on the daily time frame. So going back to what I said earlier, when we have a mixture of bullish and bearish factors, this is a time really to be standing aside from the forex market and letting the forex market dictate a direction before jumping in. Of course, if you're a day trader or a swing trader or a scalper, you may have a different approach. But those sort of approaches, the short-term approach, you very much have it against you in terms of consistent returns. Yes, it's more exciting. Yes, it involves a lot more screen time and you're taking a lot more positions. But ultimately, if we think about what's important, which is profit, you're going to make far less profit having to do a lot more work. And for most people, you really always ending up in negative over the long term. So in this sort of period where the market is unclear on a direction, ideally you want to be standing aside. So in summary, What do we want to see? Well, ideally, as already mentioned, on the monthly time frame, we see a bounce off this level and the market starts working its way back to the upside. We may get some kind of indecision candle or a reversal candle, and we start seeing momentum. Or this is temporary support before weakness back into consolidation. Now, I'm just going to load up the S&P 500 over the. Let me just delete that. I don't think I did that properly. 1 second. Excuse me. Yeah, new price scale. I think that always works better. Yeah, there you go. All right, fantastic. Now, this is the S&P 500, which is the orange line that's just overlaid on top of the dollar index. What we're seeing is, I don't know if you can see it too well, but the dollar index is starting to work its way. Excuse me, the S&P 500 is starting to work its way up, and the dollar index is starting to work its way down. So there seems to be some kind of inverse correlation going on between the stock market and the dollar index. Now, that isn't always the case. If we go back in time, we can see that there have been periods in time where when the market has been going up, the S&P 500 has been going up, the dollar index has been going up, and then there have been periods where the dollar index has been going down, the S&P 500 has been going down, and then there's been periods as well where they've been moving in opposite directions. You can see here the S&P 500 was working its way up, and the dollar index continued to work its way down. So there isn't a 100% correlation between these two indicators of the market. Right now, what we seem to be seeing is an inverse correlation. The S&P 500 is moving up, the dollar index is moving down. Of course, that could change, and we could see the S&P continue to work its way down as it has throughout 2022, or potentially we could see them both move in the same direction. It just remains to be seen. We could guess, we could predict, but a safer option is to apply patience, let the market dictate, and then react accordingly. As I said already, that's less work. And not only is it less work, you'll face less losses because you aren't jumping in at the wrong time. And then once the market does start moving in your favor and you're on the right side of the market, your profit potential increases, particularly when you hold your positions and you compound. So it's well worth applying patience at times like this. Okay, so let me just go back to this. I'm just going to delete the S&P 500. Okay, so there we have it. That is the dollar index. Right now, we are standing aside. I'm just going to have a quick look before we move into some of the other indices that I want to look at. Let's just have a quick look at some of the currency pairs so that we can see what is happening in the forex market. So if we look at the euro dollar, the euro dollar, very, very similar to the dollar index, except just inversely correlated. The euro dollar trended very well in 2014, 2015. That's when we made very good profits on this particular currency pair, shorting the market. Since that low of 2015, the market went into this consolidation. And then earlier this year, we had a breakout to the downside, just like we saw on the dollar index. Now, with the dollar index pulling back, the euro dollar is also pulling back, and it's now at this resistance level. So what remains to be seen is whether we get further strength deeper into consolidation, because technically it is now back in consolidation. If we use this support level here, price is now back in consolidation. Will it move further back deeper into consolidation, or will we find resistance and a move back to the downside? With the dollar index at support and the euro dollar at resistance, if one starts bouncing, the other is going to do the opposite and do exactly the same, but in the opposite direction. Okay, so that's the euro dollar. Let's just have a quick look at the dollar yen, because the dollar yen had been trending quite significantly. You can see that certainly since this low point here, which is January of 2021, the market found support, started working its way to the upside. Momentum really started kicking in March of this year, and we saw a good move to the upside. Price came to the 150 round number, where it found resistance, and the market is now on its way to the downside. But have a look at a little closer. Where is current price action? Well, we have a support level which goes back to January 2002. This is a little bit old because technically we only look at support levels within 5 to 10 years. When you go back over 10 years, certainly they tend to not hold as much weight. But That's not always the case. We can see right here, if I just, again, get that tool, if I just highlight this level here, and you can see that the market has come down to this level, tried to break through it, or was actually trading below it earlier this month. The bulls have come in, started pushing price up. So if the market closes above this level, we could potentially see a move back to the upside. If we get further weakness, then price is back into this long-term area of consolidation. Let's have a look at what's happening on the weekly time frame. On the weekly time frame, if I just open that up, we can see that the pullback has fallen short of the 50 simple moving average. So it is finding support at that previous level that we looked at on the monthly time frame. Further weakness will take it to the 50 simple moving average, and further weakness could then see price move towards the weekly 200 moving average. And let's have a closer look on the daily time frame. Look at where price is. It's actually bouncing off the 200 simple moving average on the daily time frame. These are key levels, guys, of support and resistance. If you're unaware of the history of the 200 simple moving average, old school traders used to draw charts by hand. They didn't have the luxury of software like TradingView that we have today. Old school traders used to draw charts by hand. What does this mean? What this means is that they were very, very selective of the indicators that they put on their charts. If you look at traders today, they have everything on their charts. It looks messy. Support and resistance, trend lines, Fibonacci extension, Fibonacci retracement, all manner of subchart indicators like RSI, stochastic. You'll then see Elliott wave counts on there as well, MACD. It's unnecessary. All you really need is to focus on price and then just have a handful of indicators to be able to develop an edge. And for me, moving averages and support and resistance are really all you need. Plus, we have a trend filter as well based on an algorithm and a logic as well. So if you've got those three things, a trend filter, which determines whether you have areas of bullishness, which are green, areas of bearishness, which are red, and then this sort of sideways markets when they are grey. If you have a trend filter that can highlight that, and then also your moving averages and your support and resistance levels, that's all you need. Now with stocks, you can also use volume. Well, you do want to use volume as well. We don't use volume for currencies. You don't have volume for currencies. You may want to use ATR. That could potentially be a replacement for using volume when looking at currencies. But certainly with stocks, you want to be looking at volume. So looking at the dollar yen, guys, we can see that price is at a support level, particularly the 200 moving average, particularly the 200 moving average on the daily time frame. So what now remains to be seen is whether we get further weakness below the 200 moving average, or whether we get a bounce and a move towards the upside. Currencies right now, apart from the dollar yen, which has trended fairly well since March, often you get into a position and the market tends to swing around at you on a regular basis. So it's very difficult to gain any sort of momentum. Okay, so let's move on to the other indices. So let's just have a quick look at what is happening on the S&P 500. And then once we have had a look at the S&P 500, we will then, we just had a look at the dollar index. Let's have a quick look at the S&P 500 mini, which gives you an indicator of pre-market action. I'm just going to go straight down to the daily time frame because that's really where we can see what's happening at the start of the pre-market. And we can see based on yesterday's move, there was a fairly bearish move to the downside, which can be expected. When you're at these sort of major levels of support and resistance, such as the 200 moving average, there's often a battle between the bulls and the bears at this level before a direction comes in. If we look at what's happened through most of this year, if we look at this area here, in March, the market moved above the 200 moving average, which is the black line, came below it. And just to highlight here, guys, look at this sort of setup here. We had a move below the 200 moving average, we had a pullback, and then we had a continuation to the downside. That's what you're looking at, either bullish or bearish. It's known as a flag formation. Move below support or resistance, in this case resistance, pull back to retest resistance, and then a move to the downside. Price found support, came back to the 200 moving average in August, it didn't close above it. We had another move to the downside. Price found support, We had another pullback to around the 200 moving average. So what we're currently seeing is the 200 moving average acting as resistance and the 20 simple moving average acting as support. And if you look at the move to the upside, whenever it comes to around the 20 simple moving average, it seems to be bouncing. So again, we can anticipate a bounce, or we can let the market dictate a bounce. We don't want to guess a bounce, because you get in too early, you will regularly be on the wrong side of the market. What we want to see, ideally, is price to move back above the 200 simple moving average and then strength to the upside. And as already mentioned, move, pull back, and then a continuation to the upside. So pre-market at the moment, quiet so far. But remember, it's the end of day candlestick that is the most important candlestick, because the end of day candlestick is also factors in the institutional money that comes in towards the end of the day. Often, if you look at price action, it can be quite noisy, tends to swing up and down through most of the day. Then the last hour or two, that's when you start really seeing a candlestick form, and that's because the institutional money starts coming in towards the end of the day. So that is where we are right now in terms of pre-market. If we have a quick look at the S&P 500 itself, we can see it closed below the 200 moving average. We want to see momentum back to the upside and then a continuation of the bullish trend. If we look at the NASDAQ is still below the 200 simple moving average on the daily. And if we look at the Dow Jones is very much leading the way. It's above the 200 moving average. It's finding some kind of support at the 20 simple moving average. Again, what we want to see is a bounce and a continuation to the upside. Once the S&P has certainly moved above the 200 moving average convincingly, that is when I will start looking for opportunities in the stock market. There are a number of stocks that are setting up really, really well, performing very well. Let's just have a quick look at some of the stocks that are already in my portfolio. So if you look at McKesson Corporation, this has been in my portfolio since last year. You can see that it's moved up 63% at its peak, currently around 55%. That's okay. It's going through a bit of a correction. If we look at the daily time frame, just a little bit of a sideways move so far, but that can happen. What we want to see now is a breakout and a nice trend emerge, just like this trend here that we saw. So McKesson Corporation is in my portfolio. Another stock that is in my portfolio is Amerisource, and that's been in my portfolio since last year as well. And you can see that not as well as McKesson. It hasn't moved as well as McKesson. It's been a much slower moving trend. But if you look at the history, it has a very good history of performance. So once the market settles down, the S&P 500 dictates a direction, then expect this stock to continue to move in the same fashion going forward. We're already starting to see signs of that. If you look at October, strong move. November, strong move. December, who knows what kind of candlestick we could have. But remember, December as well is synonymous with the Santa Claus rally. So towards the end of December, that's when we see strong moves in the market. So I like to leave my positions open. I don't generally take any positions because often the markets can be quiet, but I certainly leave my positions open, because if the Santa Claus rally comes in, then the positions that I have open will just push onto much larger profits. And then when January comes in, I will then assess my situation, tighten stop losses if necessary, and take profit. So Amerisource Bergen, I think it's Bergen, ticker symbol ABC, is in my portfolio, and you can see that it's starting to perform very well. Okay, so that is me for today. There aren't any questions at the moment. I'm just going to give it a couple of minutes to make sure that there aren't any questions coming through as yet. If you are watching this on replay, once I have come off the live stream and you have any questions, do not hesitate to reach out to us via direct message, and I will be happy to answer any questions that you have. Okay, I can't see any questions coming through, so I am going to end this stream, and I look forward to seeing you on my next live stream. Let's see how the market opens today and how the rest of today pans out. All right, guys, have a lovely rest of the day, and I will see you soon. Cheers, bye.